Have you ever worried about owing the Internal Revenue Service and then wondered how much more you might have to pay in interest? It is a common concern for many, and understanding this can bring you peace of mind. The Internal Revenue Service calculates interest on underpayments by taking the federal short-term rate and adding 3 percentage points to it. This rate is not fixed for an entire year. It is reviewed and can change every 3 months, adjusting quarterly. Interest charges begin from the original due date of the tax and continue until the balance is paid in full, compounding daily. The core mechanism behind this calculation is straightforward. Each quarter, the Internal Revenue Service announces its updated interest rates, which are derived from the federal short-term rate determined by the Treasury Department. By adding 3 percentage points to this base rate, the Internal Revenue Service ensures a consistent, albeit variable, charge on underpayments. This daily compounding means that the interest owed today also earns interest tomorrow, which can significantly increase the total amount due over time, emphasizing the importance of timely payment. It applies to any unpaid taxes, even if you filed for an extension but did not pay your estimated tax liability by the original deadline. To figure out the specific interest you might owe, you can visit the Internal Revenue Service website to find the current and past quarterly interest rates. If you realize you owe the Internal Revenue Service money, paying it as soon as you can is always the best strategy to stop further interest from accumulating. If paying in full is not possible, exploring payment options like an installment agreement or an offer in compromise with the Internal Revenue Service can help you manage the debt, though interest generally continues to accrue. An important insight to remember is that while the Internal Revenue Service may abate or remove certain penalties due to reasonable cause, they very rarely remove interest charges. The law mandates interest on underpayments, considering it a cost for the use of the government's money, similar to how a bank charges interest on a loan. This distinction between penalties and interest is key when discussing your tax situation with the Internal Revenue Service. Understanding how the Internal Revenue Service calculates interest on late payments empowers you to act promptly and strategically if you find yourself with an outstanding tax balance. By knowing the rules, you can minimize additional costs and maintain better control over your financial obligations, helping you navigate the tax system with confidence and clarity.